Let's move on to Namibia now, check in on what we're seeing on that end for the markets for the day. The overall stock exchange up by 0.8%, checking in on how the local index has fared relative to that 278 points. You're looking at it down by 0.9. Keep in mind, in South Africa, we know that resource stocks are strong today, and of course, we've seen that filter through into some of the stocks that are dual listed in Namibia. So that, of course, why we're seeing a difference there. Let's check in on how the currency is faring. 9.04 against the dollar. You're looking at the Namibian dollar up by 1/3%. Well, let's cross over to our NBC studios in Windhoek now. We've got Shaun Namaseb, Portfolio Manager at Capricorn Asset Management, standing by. Shaun, thanks for your time today. So let's just talk about the fixed income space in Namibia, because you've gone through a whole process of ranking various sub-Saharan African countries and looking at how they stack up against each other when it comes to relative attractiveness. But take us through, firstly, the process you used to rank the fixed income markets.
Okay, firstly, what we actually did was take Africa as the investable universe and then go through a process of ranking as well as filtering. Our ranking process was ranking the nations according to debt to GDP, and then filtering them according to investor rating.
Okay. So basically,
after this filter, we ended up with After this process, we ended up with basically 4 nations, which were Namibia, Botswana, South Africa, and Mauritius. Well, if I can take you through the 4 nations, basically Mauritius offered you the best value in terms of your 10-year. They offered you about a 3%. Real yield on their 10-year bond. As well, the nation's expected to grow about 3.7% in 2013. However, other matrices really troubled us about this nation. They suffer from the twin deficits of current account as well as a budget deficit. The nation also has a relatively high debt to GDP ratio of about 51%.
Certainly is high, and of course South Africa almost sitting in the same category there. Of course, our current account deficit is less at around 6%, but we also have the twin deficit problem, and we know that our debt sitting at around 41%. Growth outlook has been revised downwards. Given the fact that you're looking at Mauritius and South Africa in that light, how does Namibia stack up right now? I mean, given the fact that we have growth forecasts of 4%, where does that put the fixed income market?
Well, Namibia currently offers you a real return of about 1.7% on your 10-year. The nation has a relatively low debt to GDP, actually the second lowest from all the nations we actually had a look at around about 27%. It currently has a pickup of about 0.94%. That's above the South African benchmark, the R186. So seeing as the nation is pegged to the rand, we feel that this is actually free yield for a rand investor.
Interesting. I'm just looking at the spread right now between that Namibian 10-year debt, which was listed on the JSE, so you've got that in rand denominated, so of course you eliminate the currency risk, as you were saying. Tell us about the spread you see going forward for that relative to, say, the R2023 here in South Africa, which of course would be considered the equivalent.
Okay, what we did when we approached the valuation of the NAMA1 is also take a fundamental look at the actual bond. If you look at Namibia versus South Africa, their long-term domestic currency debt as well as the foreign currency debt has about a 2-notch differential between the two. So then we had a look at South Africa's 2020, which is South Africa's Zero bond, and the Namibian equivalent of the NAM 2021. And what was interesting to see is spread differentials post and pre and post Marikana. spread differentials on those two bonds pre-Maracano were about 1.2%. However, post-Maracano, we've seen those differentials tighten by about 40 basis points and is now currently trading at about 0.6% above the South African Eurobond. That's the South African 2020.
Interesting that, of course, it really, I suppose you could say, a gauge of what foreigners are saying.
No. Yeah, definitely. We do believe that this is the new normal. We believe that Namibian domestic bonds should tighten further, and the South African listed NAMA1, which currently trades at a spread of 105, has not taken into account the changing credit dynamics between the two countries. So we expect that bond to at least tighten by 10 basis points to bring it in line with the GC24, which is the local bond, which, as I alluded to earlier, is also undervalued. So there could be significant tightening.